High-earning W-2 employees, stop handing six figures to the IRS every single year. You're losing $50,000 to $100,000 or more with almost zero control. But the wealthy, they use these six powerful, tax-free, or nearly tax-free investments to explode their wealth while keeping almost every possible dollar working for them. And the best part, every one of them is 100% legal, and you can start applying these strategies immediately for this year and into next. Let's start with number one, the Roth IRA. This is one of the most powerful wealth building tools for tax-free growth. Here's why. You contribute with after-tax dollars. Your investments grow tax-free, and when you retire, you withdraw 100% of it tax-free. But here's the catch. High earners can't contribute directly, so we use the Backdoor Roth. Step one, post tax money into a traditional IRA. The limit is $7,000 this year and $8,000 if you're over 50 years old. Step two, convert it to the Roth IRA right away. Do it before there are any gains. Step three, now that the money compounds forever, tax-free. One important note, if you already have pre-tax money sitting in IRAs, the IRS has a pro-rata rule and can make the conversion taxable. You don't want to be double taxed. A simple fix is to roll these pre-tax IRA dollars into your active employer 401k first, if your plan allows for it. Do this every year and you slowly build a seven-figure tax-free bucket over time. And as a bonus, Roth IRAs have no required minimum distribution, so you stay in control. That's tax-free later. Now let's tax something that can be tax-free at every stage. Introducing number two, HSA, the triple tax advantage account. This is the only account that wins 3 times. You get the deduction going in, it grows completely tax-free, and you can pull it out tax-free for qualified medical expenses. For 2025, limits are $4,300 if you're single, $8,500, $50 for the family, plus $1,000 for a catch-up contribution if you're older than 55. You must be on a high deductible plan to qualify. The power move is simple. Don't spend it now, invest into your HSA, save your receipts, reimburse yourself later, completely tax-free. In retirement, HSA dollars can also go towards things like Medicare premiums and long-term care insurance. Quick warning, so you're protected, if you spend HSA money on non-medical expenses before 65, you'll owe taxes and penalties. After 65, non-medical withdrawals are taxed like a traditional IRA, no penalty. That's your healthcare bucket working tax-free at every step. Now let's use the plan you already got at work to cut taxes today and supercharge your growth. Your 401k gives you 2 wins at once. It lowers your tax bill now and sets up huge compounding later. For 2025, you can contribute $23,500 pre-tax or $30,500 if you're older than 50. Always take the employer match. It's free money. The advanced move is the mega backdoor Roth, and it is plan dependent. Your plan must allow after-tax contributions and either in Roth plan conversions or in-service rollovers. Check your summary plan, description, or ask your HR if it's possible. Here's the play when the plan allows for it. You add after-tax dollars above the normal limit, so your total plan contributions, you and your employer, can go up to $70,000 in 2025. $77,500 if you're 50 years or older, and super catch-up contributions for ages 60 to 63 in the amount of $81,250. You then roll those after-tax dollars into a Roth, either inside the plan or out to a Roth IRA. Now that chunk can grow completely tax-free. The result, you push tens of thousands of dollars more per year into the Roth space, legally and fast. Those are accounts. Now let's use an asset that can create big legal deductions. I'm talking about real estate. This is a tax engine. The IRS knows buildings wear out. That's depreciation, a paper loss that lowers your real taxes. Depreciation applies to the building, not the land. So you'll use reasonable land allocation when you buy it. The upgrade is getting a cost segregation study done. Instead of treating the whole property as one slow write-off, you break it into parts, the flooring, the fixtures, the cabinetry, landscaping, so you can deduct a bigger chunk a lot faster. When rules allow, bonus depreciation lets you pull even more in year 1. Timing matters. The property needs to be placed into service, furnished, listed, and available for rent before the year end to use those deductions this year. By default, rental losses are passive, but there are 2 legal ways to let those losses offset high tax income. Path number 1 is a short-term rental with material participation of at minimum 100 hours. The average stay has to be 7 days or less in the property, and you're hands-on with clear time logs. Path number 2 is real estate professional status within your household. 750 hours is the time you're investing, or more than half of your working time is in real estate, plus your material participating in those rental properties. If you meet one of those 2 paths and document it well, you can offset income this year while keeping cash flow and building more equity. If you don't meet those paths, the losses don't vanish. They carry forward to offset future passive income or gains when you do sell. Next is a tool the wealthy use to store and access capital with powerful tax treatment. Quick pit stop, if you're a high W-2 earner making over $3 $300,000 a year, you're tired of seeing a huge chunk of your income disappear to taxes, listen up. In the last 12 months alone, we've helped over 250 of our clients save over $12 million in taxes using our tax return system. This will 3x your refund this year without changing your CPA, without changing your lifestyle, and without wasting hours on unnecessary tax planning. Book your free tax strategy session using the top link. That's it. Now let's talk about the next tool the wealthy use to store and access capital with powerful tax treatment. Tax advantage life insurance. Not every life insurance policy is built for wealth, but the right design can act like a tax advantage vault. Here's what you get when it's built correctly. Cash value grows tax deferred. You can access money through tax-free policy loans. Your heirs receive a tax-free death benefit. There are no income limits and no required minimum distributions. Couple cautions so you do it right. First, it must be designed to avoid MEC status or you lose the tax perks. Secondly, policy loans accrue interest and reduce the death benefit if unmanaged, and these policies have real costs, so you want a conservative design and funding discipline. For high earners who've maxed the usual accounts and want protection, liquidity, tax favored access to your capital, this can be a very smart supplement to your portfolio. And finally, number 6, this is one of the most underused tax deduction levers in the entire code, and that is starting a simple, real side business. This flips the rules in your favor. As a W-2 earner, your deductions are painfully limited, but once you're a business owner, the tax code, specifically section 162, lets you deduct all ordinary and necessary business expenses. In other words, real costs that are common and helpful for your work type. Typical deductions include your laptop, phone, internet, software, your actual home office, education, travel, legitimate business meals, marketing, paying contractors, even paying your kids for the real work that they're doing at fair market value, up to $15,750 completely tax-free for your kids in 2025. Two big wins happen. First, you can reinvest before tax, so the IRS takes a smaller bite. Second, you create a second income stream and you build equity. Level up when the numbers support it. Elect an S-Corp once profits are around $50,000 to optimize your salary versus distributions. Use an accountable plan to reimburse business expenses pre-tax. Use the Augusta rule to rent out your home to your business for up to 14 days, completely tax-free income when it's done correctly. And one more guardrail, make sure you actually have a profit motive, clean documentation so you don't run into hobby loss rules. Separate bank accounts, simple bookkeeping, save your receipts, makes all these savings stick. When it's done right, we routinely see $20,000 upwards to $50,000 saved in the first year. If you want to take the next step and use real estate to push your tax bill down even further, you need to watch the next video, how to use real estate to legally lower your W-2 taxes. In that video, I show you step by step how to turn depreciation into real estate, legal deductions, choosing the right lane, short-term rental or real estate professional status. Follow the simple 5-step checklist so your paperwork matches your plan and the savings actually count. And if instead you want a tailored plan that can help you implement to 3x your tax return without changing your CPA, book a free tax strategy session using the top link. And remember, small moves made now beat big regrets later. Make your money start working for you, not the IRS.